I'm Deborah Borchardt, and this is your midday market update. Well, right now, stocks are in green territory. We are moving just a tad higher, but really not a lot happening down in the stock market today, probably because we have the Jewish holidays. So the volume is a little bit light, but just not a lot of reaction to any of the news that we've gotten out today. Joining me is Ben Willis from Albert Fried. So Ben, we were just talking about that. We've had a lot of economic data come out this morning. Nothing has really moved the needle today.
No, I'd call it the Kermit market. It's not easy to be green. It's barely holding on, nothing really happening. You saw the algorithm-based trading react every time there's a headline. The interesting one to me was the Gallup poll that came just before our opening. The market's opened a little bit softer than the futures had been telling us at about 9:15. It had a little bit of a reversal. Then we climbed back on board the green line, and we continue this little movement. But the fact of the matter is we're still, for whatever reason, in this summer mentality. The market's really waiting. We're going to wait for the unemployment number tomorrow, the real number from the BLS. And I think the real focus, you have to watch the forest for the trees, keep an eye on the yields on the 10-year. Money continues to draw out of the bond funds, finding its way first appears into money markets before it kind of slowly drips into this market, the U.S. equity market.
Well, you do bring a good point on the bonds, because we are now seeing those 10-year Treasury yields start to inch closer and closer to 3%. We haven't seen that in a long time, and it does seem like, boy, those bondholders are just bailing out.
Yeah, I mean, occasionally I do bring up a good point. I mean, so I know it's rare, but it is. It's been. But the fact of the matter is, for traders, it's kind of, you scratch your head, like, why is anybody still in bonds? It takes a long time for the public that has their money and their trust in the bond market, because they were scared out of equities 4 or 5 years ago, and rightfully so. They stayed in that safety, and it's going to take a while to unwind that trade, so to speak. And I think that's a function of what we're seeing and working its way back into the justification. And when you get these cross currents or numbers like the ADP, which are okay, but really not, it makes you still hesitant to decide really where to invest your money. And I think that's what we're seeing right now.
All right, we do know that the Fed owns, about 30% of the bond market right now. So as these prices go down, what is that doing to their positions?
Well, people will open up their monthly statements or their quarterly statements, and they're used to seeing in their bond funds $272,000, $275,000. Now they're seeing $270,000, $263,000. And it's not quite a rude awakening, but it's going to become more so as they start to realize that the safe haven they thought they were in actually does have downside risk, and based on their principal markings, and that's what we're seeing. I think that will continue. You're still at generational lows when it comes to interest rates. So, you know, the positive, the bull argument is that the economy will function just fine at mortgage rates at 5%. It's okay. That's still lower than your parents probably paid, or I paid on my first mortgage. Now that I'm old, but you know, it's okay. But the market's going to take the investing public is going to take some time to come around, because they don't function as algorithms do when they see headlines and instantly trade.
All right, so we will expect, as Ben said, as more and more people see those values come down, that you might see a build of that selling happening. Right now, we're at the stock market and talking about stocks. Well, they're still up so far in the midday range. That's Ben Willis from Albert Fried, and I'm Deborah Borchardt with The Street.